As a human, when life gets busy and when you're stressed and you got a lot on your plate and you're feeling overwhelmed, you shift into survival mode. That's human nature.
If I'm a CPA and I'm saving my clients more money, that's going to help accelerate word of mouth and it's going to help build my book. Why are they missing this?
You've seen things in the news the last several years where like an Elon Musk or Donald Trump is paying like almost no taxes. And people get frustrated. How are they doing that? The billionaires are not paying anything. It's a bit of a misunderstanding to say they're not paying any taxes, but they understand how to leverage the tax code in a way that helps fuel their investments, fuel their business endeavor. The tax code is really written like a game of chess, but most people are playing checkers. If you had someone come along and say, hey, that rook can make this move, and you never heard that before, and your advisors have never told you it can, you think they're crazy.
Yeah.
You know, I'm going to get in trouble if I make... No, it's designed to make these unique moves that can give you an advantage on the competition.
All right, today our guest is Justin Rupple, and he is with Elevated Tax Strategies. He's the founder. Justin, I'm super excited to have you with us. There's a ton of ground to cover. You obviously offer a wide variety of opportunities for people to lower their taxable income. And this is a fascinating topic. I saw you speak previously and just had to bring you in so you could share some of your knowledge with the audience. But before we jump into, the strategies and all the different things that you offer and how people can lower essentially their what they pay in tax, maybe you could tell me a little bit about your background, how you got here. Obviously, I imagine you didn't grow up as a little kid wanting to lower people's taxes. So maybe you can just explain, maybe it's just your journey to this place and how you ended up where you are.
Sure. Well, first of all, I appreciate the invite to be on the podcast with you. It's great to be here. So thank you so much. I'm happy to do this. Love opportunities to educate business owners, real estate investors, people paying taxes of how they keep more money in their pocket. I didn't go to accounting school. I'm not a CPA. We make it really clear because what we do is we work with business owners and real estate investors predominantly, partnering with their CPAs to help them take advantage of advanced tax strategies that CPAs do not specialize in. The way that I got into this is unique. I actually, about 15 years ago, was a health insurance and life insurance broker, did group benefits, worked with a lot of small business owners, helping them set up benefits packages. There's elements to that provide tax benefits for the organization. And so we're basically consulting with business owners on ways that they can be strategic about how they offer benefits that actually reduce costs in the most tax advantaged way. So that's what we were doing. Really enjoy what we're doing, taking a more kind of a creative, strategic approach. In every industry, you're going to have people that are more transactional and there are more that have a consultative, strategic, kind of proactive approach to what they do, whatever it is. And that's how we like to do business with our clients. Well, after doing that a number of years, I think now or probably 10 years ago, we got connected with a specialty tax firm that we were so intrigued with what they do because their value proposition was business owners are leaving money on the table because of tax credits they don't know anything about because their CPAs aren't bringing it to the table because it requires kind of a specialized service to take advantage of. Yeah. As we were learning what they're doing, we were intrigued because so many of our clients fit the description of eligible businesses. So we're like, wait a minute, tons of our clients are leaving money on the table all because of tax incentives and tax credits that their CPAs aren't telling them about. It's one of those things when you know a good friend is leaving opportunity, you almost feel morally obligated to tell them about it, right? That was a big part of what we're doing. We're like, hey, there's so much opportunity here. Our clients are leaving this money. What if we can bring this opportunity to them? And so we basically became the marketing arm of a specialty tax firm. We're saying, hey, you, the tax specialists, they were CPAs and engineers, mostly helping businesses take advantage of the research and development tax credit. It's a lucrative tax credit. It's been around since 1981. It's nothing new. And yet most tax preparers, CPAs or EAs that do tax preparation for small, medium businesses, if you were to ask them about it, they would admit they know little to nothing about the R&D tax credit. And I've yet to ever meet one that actually knows how to do the work thoroughly to take advantage of it. It's a specialized service. Businesses require an annual credit study developed with robust documentation that the IRS requires. The calculations are complicated. That all needs to get done by a specialist that gets handed to the CPA to incorporate into the tax return. So it's kind of like an add-on specialty service. And there's actually a whole industry called specialized tax services that do these kinds of things. Well, there's a huge disconnect between the CPA working with the business owner or the real estate investor and these specialists. That's where we come in. We work right in the middle, hands-on with the taxpayer, which is the business owner or real estate investor, connecting them to the specialty services that make sense to them, that are going to bring value, that are going to take advantage of things like a tax credit or a strategy And that all is complementary towards what their CPA does. So we saw 10 years ago this opportunity of like there's a gap here. There's the CPAs are the main one that taxpayers are looking to say, hey, my CPA, what opportunities can I take advantage of? Well, they're dropping the ball here. And a lot of it is not to fault them. Tax preparation is generally a low margin, high volume business. It's competitive, which means they've got to have a lot of clients. They're busy doing tax prep, doing compliance work, and that's fine. They can keep doing that. We can come and work with the client and say, hey, what opportunities are being overlooked? Maybe it's a tax credit. Maybe it's a tax incentive. Maybe it's how you're structured with your investments or your business. Maybe it's how your employee benefit programs are set up. There's tax savings opportunities there. Maybe a big liquidation event like selling a business or selling real estate. What opportunities and strategies can be brought to the table that can significantly reduce their taxes? And the goal is to help keep money in your pocket, not just for the sake of having money in your pocket. Our clients are smart business owners, smart investors. More money in their pocket means more capital to invest and more money to leverage, more way to grow my portfolio, whatever that is. And so we're seeing tax strategies as opportunities. As we got into this and consulting on tax incentives, that slowly grew as we identified so many other opportunities that people are just not aware of. So we're constantly educating, love doing podcasts like this, sharing with people the opportunities to take advantage of, ways that they can wisely leverage these different strategies to accelerate towards their goals. And that's what we're after.
Perfect. Well, you're the man to talk to. So, you mentioned, this R&D tax credit, but what are some of the more like common, and maybe that is common, obviously, but what are some of the more common misunderstood or I would say overlooked tax credits that are kind of just like you're regularly surprised people don't know about?
Yeah. There's some of these things that I consider kind of the low hanging fruit. It's just money being left that can be grabbed at if you knew about it. R&D was one major one, and I'll just bring this up because this new tax bill just passed, the one big beautiful bill.
I do want to ask you about that.
So this leads us into that a little bit because we got into this by helping businesses take advantage of the R&D tax credit. That was kind of what got our feet wet in tax strategy consulting, and that's enormous benefit because we're talking to business owners saying, hey, some of the work you're doing automatically already qualifies you for this tax credit. You just didn't even know to claim it. And we can help you do the proper documentation and calculations, which literally just means money back in your pocket. With that tax credit, you can go back 3 years and retroactively claim refunds. Usually I'm telling business owners, hey, I got good news for you. We can go back, claim 3 years. The bad news is I can't go back the last 20 years of in existence, but we can start now because it's things you're already doing. A lot of business owners, I have to help them understand what qualifies as R&D is actually much broader according to the tax code than what we usually think about in our minds. We usually think high tech. We think, creating some new innovation, some, new discovery. Now, that certainly is R&D. But I'm working with a lot of, I would say kind of blue collar kind of work, dirty manufacturing, fabricators. I tell business owners, look, if there's some work you're doing where you're having to figure it out, like you're not totally sure how we're going to accomplish this, then it's scientific or technical in nature, whether it be architectural engineering. It could be, there's a lot of different types of manufacturing. I mean, I'm working with a company right now that basically soups up hot rods, but they actually do a lot of fabricating because they're custom making parts for these phenomenal high performance cars. And there's actually a lot of R&D going on there. It's grunt work, it's messy, and yet it qualifies. And so we're helping them take advantage of that tax credit. Like it's just money being left on the table. So we're looking at that. Part of it is just how a business is structured. The CPA kind of is their go-to, like, hey, if you're a profitable business, this is how you need to be structured. And CPAs are also mindful that they're not attorneys. Yeah. They can't give entity structure advice. And that's smart. You go to your attorney for that. Well, but your attorney, your business attorney that sets up your entity, writes your operating agreements, your bylaws, or however that is, they're not well-versed in tax strategy. And so they'll defer to a CPA for tax advice. Well, then you're getting stuck between these two advisors that won't talk to each other, that are pointing at each other. We come in the middle. One of our key specialists is a tax attorney who's also a CPA, and his specialty is business tax strategy. He'll help develop sometimes a more robust entity structure where you're leveraging a dual entity structure with different types of entities to leverage different kinds of rules. And that's a way that when you're an S Corp, you're excluded from taking advantage of C Corp tax rules. And when you're a C Corp, you're excluded from taking advantage of S Corp tax rules. Well, there's actually ways you can implement a dual entity structure to be more tax efficient every single year. And you just systematize And now we help a lot of our business owners, we're saving $50,000 to $80,000 a year with a structure like that. And it's not just a tax credit, it's just a structure that lets you take advantage of different kinds of rules that you can't as a single entity.
Yeah.
Things like that we're seeing constantly.
Yeah, and entities are a popular topic in real estate because there's always this kind of like, do I have a corporation, an S corporation? Obviously it really comes down to the type of activity you're conducting.
Absolutely.
But, that's obviously, like you just mentioned, is a tax strategy. And people, I think a lot of times are just thinking, S corp or LLC, maybe trust, but they don't think about what you kind of alluded to, which is like, depending on your business and how you operate in real estate, and if it's like a full-time thing versus not, having a C corp might render some benefits for you. Interesting. And so you guys help advise on entity kind of structure or restructuring potentially with your group?
Yeah, that's a big part of what our tax attorney brings to the table, is because his specialty is tax strategy. And so he looks at how things are structured, what's actually happening, because it's one of those things where everyone's situation is different. And so there's no one size fits all. We look at, when you have held for investment real estate, that's a passive activity. The go-to is LLC for that. Moving a property in and out of an LLC is not typically a taxable event. Moving a property in and out of an S corp causes lots of problems. So generally speaking, you don't put your property in an S corp. But I even say this with the disclaimer of, if you're listening to this today, this is not tax advice. Everyone's situation is different. We need to have a conversation about your particular circumstances to determine what the right advice is for you. But generally speaking, your property in an LLC makes sense because that's a passive activity. But then you have circumstances where someone's full-time or majority time dealing with managing their properties or investing in real estate or brokering real estate. Well, now we're getting into things like real estate professional status. And then there's an actual business side to that maybe should be carved out and put in an S corp, and so that's all part of what does that look like and what's the most tax advantage way to do that, and then that becomes more robust to where in a C corp, they have better rules when it comes to compensation, fringe benefits, payroll deductions. So there comes a point where that makes sense to pull out and put into a C corp because of more tax advantage rules that we can take advantage of that owners of S corps. If you own 2% or more of an S corp, you can't take advantage of all sorts of preferred kind of tax advantage compensation
HSAs,
rules, all this
like
kind of.
that.
There's a whole litany of them.
Yeah.
And so everyone's situation is different, where we can look at what's the best strategy to leverage the best rules to accelerate you towards your growth, what ultimately means more money in your pocket, which means more money you can leverage to accelerate your investment, whether it be investing in your business, investing in your real estate portfolio, investing in real estate funds, or whatever that might be.
Yeah. Cool. Well, that's great. Why, you kind of touched on this a little bit, but like the question is, and I learned this early on, is like I would go to my CPA, and not my current CPA if you're listening, but earlier on.
Good catch right there.
Yeah, exactly.
You got to stay friends. Yeah,
exactly, yeah. But, I would go and be like, hey, I'd be introducing them to ideas that I had heard about or read about. And I wasn't an expert, so I was just bringing it to them. And either it was news to them or they were kind of dismissive of it or whatever it happened to be. And why do you think CPAs, you alluded to the fact that it's a volume-based business, but, in some ways, like if I'm a CPA and I'm saving my clients more money, that's going to help accelerate word of mouth and it's going to help build my book. Why are they missing this?
Yeah, you're talking like an entrepreneur who's looking for opportunities and all that kind of stuff, long-term thinking. Not all CPAs are wired that way, and I certainly, if you're CPA listener today, certainly not meaning to slam the CPA community at all. But I've seen time and time again, it's a bit of a trap that CPAs sometimes find themselves in creating a book of business, relying on compliance work, doing tax returns. It's a low margin, high volume business, so you're so busy. I don't know if you were to kind of focus on the humanity side of things, put the CPA aside. As a human, when life gets busy and when you're stressed and you got a lot on your plate and you're feeling overwhelmed, you shift into survival mode. That's human nature. We all do it in different ways. I got 4 kids. I have been in survival mode for the last 14 freaking years.
Imagine.
I love my kids, but my gosh, my wife and I times are freaking out, and we need a vacation, and we need a break, and we need support from friends and family so that we can take a deep breath and come out of survival mode, because you think differently when you're in survival mode.
Yeah.
The kind of rat race of the tax deadlines that pepper throughout the year and the busyness that creates and the survival mode it can sometimes put people in, it causes you to be significantly risk adverse, where you actually see opportunities as risk. You see opportunities as threatening. And so you move into a kind of a mindset that is, I just need everything to be simple and easy, autopilot. You're busy, you're trying to get everything done before deadlines. And then you have a client who's taken more of your time saying, I saw something on TikTok.
Yeah.
They're talking about cost segregation and bonus depreciation. And why am I not doing that? And short-term rentals and all this stuff. And the CPA is like, I don't got time for this.
Yeah.
And
it's not part of the package.
Yeah. And every tax return that I'm putting my name on, which is a liability. So I need to know that everything I'm signing that tax return, everything that we're doing, I have thoroughly researched and vetted it. And I know we're doing it right. Now, there's nothing wrong with vetting what we're doing.
Sure.
Absolutely.
No, you want to. Yeah.
Because we want to make sure that anything that we're helping our clients explore are still well within the guardrails of compliance. That is absolutely, and there are bad players out there that are pushing fraudulent tax schemes that are giving people, I mean, it's like when you watch a TikTok video or an Instagram reel all about how I did this and I'm not paying any taxes, if they're telling the truth, they might be lying. If they're telling the truth, there's always more to it that they're not saying in a 30-second reel. And so that's why Instagram and TikTok are great for introducing concepts and ideas, not great for taking action. I can see CPAs are seeing that dynamic play out, getting frustrated, going, I don't have the time or energy, because a lot of times their billing structure is set up in a way that I'm not getting paid to bring more value. And therefore, I'm effectively de-incentivized to putting more time into figuring out how to help your specific situation. Not all CPAs are set up that way. I've seen some CPAs that are really trying to revolutionize the tax prep industry, shifting from tax prep to tax advisory, where they're saying, hey, we're charging more, but we're also bringing more value. That's not the norm, I'm finding, but there's some that are making that shift, and I applaud it, because they're spending more time and energy staying current on things like this new tax bill that we referenced a minute ago. Because like I was saying about the R&D tax credit, I had a lot of CPAs, even, this is 5-10 years ago when we were first starting to bring this to our businesses, that are like, oh, you're freaking out. You're going to get audited. I don't have enough time to figure out if what you're claiming is legitimate, so don't do it. Well, the problem is your unwillingness to do the work, to be able to kind of be on board to support a viable opportunity for your client. I've seen times it's costing a client hundreds of thousands of dollars being left on the table that they legitimately can claim. And then this new tax bill comes around and significantly changed the rules with the R&D tax credit, which made it much more lucrative than it's been the last few years to take advantage of, which I'm really grateful for. We have a ton of clients working right now to claim a ton of money being left on the table. And if their CPA is standing in the way of that, not because they don't want to support their clients, it's just because they're too stressed, don't have the time or energy to do the work. It puts them against us, and that's not where we're trying to do or we're coming at. But it's unfortunately part of the nature of the dynamic that currently exists. And I'm glad I see glimmers of hope of ways that's shifting. That's good, and we're here to help support that shift, because we don't replace someone's CPA. We're here to help support them through the process of making sure their clients are running more tax efficient, take advantage of every strategy that can benefit them.
And that's great. And, and I get it. Like, you bring up a good point. Like when you're dealing with volume and you're in survival mode, I mean, it's also just, you're putting your name on something and you're like, gosh, if I have to go testify and deal with this, and, it can be problematic. And, in real estate, we're a fiduciary when we, manage or broker transactions. And we have to take all kinds of things into account and handle things, more conservatively than we would if it was our own property, just because unless that client is fully informed about what that activity is going to look like and they can fully appreciate that, which very few people are willing to put in the time to do that. Yes. Kind of like, this is how we're going to do it because this is what scales. This is what you can do consistently. If you want to do these one-off things or go down these, roads where you could maybe hit a home run, that's great, but there's also a lot of risk. Our kind of general advice to a lot of people, because their appetite for risk is really not that high. People romanticize the idea of taking risk and making a lot of money, but when you lose money, it's a totally different conversation.
Absolutely.
And a big deal. So I can kind of appreciate that. Before we go into the future, I do want to kind of just talk about maybe how your business worked with people over the last 5 years, especially because this is kind of the COVID era. We had like the PPP loans, we had the ERC loans. Yeah. Is that stuff that you guys got involved with at all, or does your kind of expertise focus on, things a little bit differently? Maybe you can kind of explain how you guys have helped people in the last 5 years.
Yeah, and even this particular issue with some of the COVID relief funding was a place that some of the dynamic of some tax professionals taking the position of, we're just going to stay away from anything that seems too good to be true. And their mind defined too good to be true as in there's money for you, which is unfortunate because government creates tax incentives to incentivize businesses to do business and grow and stay viable. And they're doing it on purpose. Legislate, like whether it be the R&D tax credit or the employee retention credit or the PPP loans, those are created by Congress to incentivize businesses so that you can take advantage of it. I've seen a lot of tax professionals push their clients saying, don't do it, you're going to get audited, the government's going to take it all back away from you. Well, first of all, that would be illegal for them to do that because it's literally created by the government.
Sure.
Second of all, the business down the street to take advantage of it and you not to is unfortunate, puts you at a disadvantage. And so we worked with a lot of our clients now, PPP loans came through a lot of banks, things like that. That was just great opportunities, and many took advantage of it and were able to get the loan forgiveness and all of that. We didn't, because that was from a different provider. That was mainly through funding sources and banks and all that kind of stuff. Then the employee retention credit was a tax credit. It was a payroll tax credit. We helped a lot of organizations, nonprofits, and businesses take advantage of that. The window expired April 15th of 2025 to be able to claim that. But even those weeks preceding that, we had a number of clients that it's kind of the 11th hour, more like the last 10 minutes, getting those filings. Well, a number of them are starting to get paid out right now. And in some cases, they had people telling them, don't do this, all this kind of stuff. And they're getting checks right now from the government because they took on risk, weathering COVID, putting the time in. So that was a great example of ways in which we're seeing businesses significantly benefit from taking advantage of these incentives. And part of what I tell people is we're helping businesses and real estate investors take advantage of the strategies and incentives that the big corporations and the ultra wealthy, they're doing all day long. And so these aren't risky things. Whenever you take advantage of a tax strategy or apply for a tax credit, you got to know that you have the proper documentation to support your eligibility of it, or that it's structured in the right way. Absolutely. And that's what our specialists that are CPAs or attorneys that are helping do these different strategies. Big part of it, all of our specialists fully support their work. So if there ever is an audit, they will support that audit at no additional cost, because our key thing is you have to back up your work. And that's a non-negotiable with any of our specialists working with our clients, is that if anything ever gets scrutinized, they'll support it. But everything we're doing is built into the tax code. It's leveraging the tax code in the same way that the big corporations are. They're not leaving a dollar on the table. There's a reason why you've seen things in the news the last several years where like an Elon Musk or Donald Trump is paying like almost no taxes. And people get frustrated. How are they doing that? The billionaires are not paying anything. Well, first of all, it's a bit of misunderstanding to say they're not paying any taxes, but they understand how to leverage the tax code in a way that helps fuel their investments, fuel their business endeavors. And a lot of it is especially different kind of tax deferral strategies, ways they can leverage this asset to offset taxes and with this asset, which helps accelerate their investment in that asset. There are different moving parts to it. And what it is small, medium business owners and real estate investors often just don't have consulting and the advisory to help them understand those kind of moves that you can make. And Congress is smart. The tax code is enormous, but they've created it to incentivize business and real estate development, because that's what builds cities. That's what drives the economy. That's what creates jobs, which ultimately creates more of a tax base. They've done this on purpose, and so we need to take advantage of it in a strategic way. I've also heard it said that the tax code is really written like a game of chess, but most people are playing checkers.
Sure, yeah.
And if you had someone come along and say, hey, that rook can make this move, and you never heard that before, and your advisors have never told you it can, you think they're crazy. I'm going to get in trouble if I make... No, it's designed to make these unique moves that can give you an advantage on the competition. Well, let's start making the moves the tax code is written to make. Nothing wrong with that. And it's actually smart business.
Well, yeah, and I think chess is a great analogy, because chess is a game of skill, but it's also about understanding patterns and also understanding the different plays. That's why there's literally chess books that it's just 500 pages of different board moves. Yeah. And, it's like you could play against somebody who just mastered the game really well. And like in some level, you're like, wow, they're, smarter than me maybe. But in reality, it's like they just know all the rules, right? And they know the strategy. And so there's just tried and tested, moves that you can make in response to someone else's, obviously. And that's going to give you a major advantage. That's a good analogy.
Do you mind if I give you an example of something like that? Getting into a specific tax strategy?
Yeah, we love examples.
For example, a lot of our clients are business owners who also own real estate. For a lot of business owners, they're developing a business, they get profitable, and they start buying real estate as an investment as well. And so many of our clients have both of that. And so a big part of what we're looking at, hey, how do we leverage your real estate holdings and the depreciation that's trapped in long-term depreciation through cost segregation. So that's restructuring that's depreciated. Take advantage of bonus depreciation, which just got renewed by this tax bill back at 100%, which makes it more, even greater benefit for how we can leverage that. And what are the pathways that we can effectively extract tax deductions that are trapped in your properties to offset taxes from the business side, which means keep more money in your business, which helps you grow your business. So we're looking at how we can leverage one for the other. And so that, and there's barriers like real estate's a passive investment. Your business is active or your W-2 earnings is active. There are ways that we can cross from passive to active through things like short-term rental or real estate professional status. And there's parameters around those. We got to talk through what's legitimate, what fits the actual circumstances. Sometimes there's changes they can make in their lifestyle or how they run their business that can open up to those opportunities. Either way, they're strategic moves. I've had some people challenge some of that thinking. They go like, well, why would you do that? Because there's things called depreciation recapture. If you take these deductions off your property today, when you go to sell some point down the road, you're going to repay that. Yeah. That's valid. Sure. Absolutely true. But say, hey, you're not thinking strategic. Taxes are often done looking backwards, just what makes the most sense, how everything gets filed. It's a reactive, retroactive look back.
Yeah, that's how I spent most of my life.
Yeah, and there's very little you can do. There's some things, but very little you can still do that's meaningful from a strategic standpoint looking backwards. But if we look forward towards where are your goals here? Are you trying to develop a real estate portfolio, diversify? And most business owners, all their wealth is trapped in their business. And that's still maybe giving them a meaningful return. So it's not nothing bad with that, but it's not diverse. And so they see the need to start, hey, I need to start building wealth in other areas as well. So real estate becomes a meaningful way to do that. Well, if you could do that in a tax advantage way where we can borrow deductions here, aware that it's not a tax elimination strategy. It's a tax deferral strategy. It's basically saying, hey, government, I'd rather pay you later. I want to use this capital today to build wealth.
Yeah.
Knowing that I'll have to repay that down the road, but a smart investor, they'll take that all day long. It's like a zero interest loan from the government. I'll capitalize on tax savings today that I can redeploy in my business or in real estate investment or other kind of investment opportunities, knowing it will come due down the road. No big deal. I can have that all in mind. It's all part of the plays I'm making because I'm playing chess here. And I can realize I can move this here to do that. And that further gets me across the board to win the game. And that's what we're trying to do, to be smart about these things. Some of the things you see on TikTok and Instagram, all that kind of stuff, they're not all bad or wrong, but they give the wrong impressions that I can just eliminate taxes by just doing this or that. Well, no, it is more complicated than that. But that doesn't mean we should just throw it all out. These are still great moves to make in the right circumstances with understanding the long-term implications of them. It still provides great advantage for me today to be able to make better decisions in how I'm running my business or how I'm investing in real estate.
Yeah. No, I think that makes a lot of sense. And, it's moving towards the strategic approach, like you said, and so it's basically thinking about like, what are my goals? Because you talked about obviously the depreciation component. There's different ways, obviously, that can be tackled, but then you can exchange, right? Down the line. So, and then you exchange long enough, then it moves off to, your maybe kids someday, right, from the estate planning standpoint, and they get a stepped up basis. So it kind of changes the game.
We've brought that same thing up. It's like, you're borrowing these deductions, doing things like cost segregation and bonus depreciation to take advantage of today. Well, there's great benefit to that because if I can have capital today that I can free up to reinvest in something that provides a return and pay that later, even if you do sell and pay the tax when you sell your property, you still end up on top because your ability to redeploy that capital today in whatever means you desire to. But also down at that point, there's opportunities like a 1031 exchange that can further defer, and then even part of what we're trying to do is even what's the best way to do a 1031 exchange. And that's where people think there's only one type. Well, there's actually a partner with that does 1031 exchanges that do free 1031 exchanges, no cost. And then because 1031 exchange companies, I don't know if you knew this, but they make all their money not from their fees because most 1031s are $1,000, $1,200.
Yeah, inexpensive.
They're pretty inexpensive. Yeah. How are these 1031 companies have all these sales reps and all this kind of stuff? Well, it's because they're sitting on millions of dollars of capital and they're investing it short term.
Sure.
Because they're holding onto it up to 180 days. Well, mostly they're sitting on tens of millions of dollars. And these intermediaries, you realize that? That's where they're making their money.
That's wild, yeah.
Well,
it's like a bank.
Yes, exactly. They are a bank. They're holding onto the money. There's a 1031 company that I partner with that will do free exchanges. And if your funds are more than $1 million, they'll actually share interest with you. At the very least, you're saving $1,000.
Sure. I mean, that's a win right
why
there.
not?
Yeah.
And if it's a significant exchange, they'll share a percentage of their interest. They shared with me one of their clients is doing a large commercial property, $40 million exchange. While it's sitting there for up to 180 days, he's getting paid $90,000 a month in interest. So they're saying, and we'll pay you for letting us hold your money.
That's incredible.
So,
I've actually never heard of that.
You never heard of that? Okay, so I'm glad to bring something you never heard of. That's not even what we came here today.
No.
So that's a great strategy. And then also I have a client right now, he's selling a nearly $19 million property, commercial building, and he doesn't want to do a 1031 because he doesn't want to get stuck in real estate. And I don't say that being in real estate is a bad thing.
No, I mean, you got plans
for his
and
lifestyle, for his goals, but he feels trapped. Like there's no way out without taking the massive tax hit because he'll have about a $12 million gain on that. And federal state capital gains and the net investing income tax, it's looking at $4 to $5 million of taxes right off the top. That's a huge hit. Well, there's actually 1031 alternative strategies, and one of our key specialists, it's using Section 453 of the tax code instead of 1031, which governs installment note agreements, where they actually can create a structure that can capture the proceeds from the sale tax deferred for up to 30 years.
Oh, interesting.
Like a 1031 with a deferral, but with unlimited reinvestment options and no time constraints. So he can have his full taxable gain go into the structure, and he can work with his financial advisor to reinvest this in securities, stocks, or other real estate with no time constraints, no like-kind requirements. And if he redeploys this funds in another real estate investment, he can actually get the full tax basis or depreciation of the next property purchase. People are listening that are into 1031s. The downside is time constraints, so that eliminates that.
Yeah.
And the downside is your diminished tax basis because you inherit the depreciation remaining from the previous property into the next.
Yeah.
So the whole idea of 1031, you're constantly leveraging up, which is a great way to build wealth. But also your deductions and depreciation are diminishing every move.
Yeah, you erode the basis.
Yes, you erode it. And so there's people that have been doing that for decades, and now they've got maybe a $15 million portfolio with like no basis. So it's all gain when they go to sell it. Now, you mentioned with estate planning, you can have this move into your trust. When they pass away, the children get the step up in basis. So that is a way of literally eliminating the tax on that. They get the new step up to the fair market value. That's great. But I've seen other people that doesn't meet their goals or their children. I had someone literally tell me yesterday that their clients' kids don't want the properties. They're like, please, don't give those things to us for whatever reason. That's just where they're at.
It's actually more common than you'd think.
Yes.
It's actually a lot of people, especially sometimes it's the second generation is more open to it. But once you get past that to the third generation, their level of interest in it is very detached.
And sometimes that's the case. And so these strategies provide a way out of 1031 with continuing to defer the taxes. And so there's all these ways you keep kicking that tax can down the road, redeploying that capital for wealth building, for legacy planning for your children and for your heirs. There's so many different moves that you can make that are strategic, that keep kind of fueling your move towards your goals. These are what the ultra wealthy are doing all day long. This and many other kinds of moves. Our passion is to make their strategies that they're leveraging accessible to the small, medium business owner or real estate investor. That's what we're here for. And you'd be blown away at the kinds of opportunities that we're seeing every day that people are overlooking just because they've never heard about it.
Got it. And so just kind of staying on that thread about, generational estate planning. So you guys help people with estate planning. If somebody wanted to come to you guys, and they're just trying to think ahead, is that something that you guys help them triangulate and strategize around?
Like what we're doing with tax strategy as far as income tax or real estate or business tax strategy, our role is that strategic consulting around how things are structured or leveraging the rules the right way. It's not to replace the CPA that's doing tax prep and not to replace the estate planning attorney that's actually writing the estate plan, because that gets into things like durable power of attorney and your medical proxy, all that kind of stuff.
Yeah.
Very important to really understand, the event of me being incapacitated or my passing, how that all flows and who makes decisions. That's vital important. The tax strategy side of estate planning, we're able to partner with an estate planner to make sure that their estate's being structured in the most tax advantage way. This new tax bill just bumped up the federal estate exemption to $15 million per taxpayer or $30 million for a married couple. So that means you're not paying estate tax unless your estate, if you're married, is of $30 million in value or more. That's huge.
Yeah. What was it previously? Because I actually didn't know.
So back in Trump's first term, it more than doubled it and it got to the point where it was around 13 million.
And that was the Jobs Act? Is that
Tax Cut and Jobs Act in 2017? Yes. So that got passed, but that was going to expire at the end of 2025. If the new tax bill didn't get passed, then it would have dropped down to pre-2017 levels, which I forgot, it was somewhere around 6 million per taxpayer.
Okay. Yeah, so
still significant. Yeah. But for those that are in between those numbers, it's going to create because
huge event.
The state tax is a 40% tax on anything above that threshold. And during the Biden administration, he threatened to drop it to $1 million per taxpayer. That's a huge drop.
That's
now,
such a low threshold when you think about that, especially this day and age with like how much money that is. That's just
our
insane.
tax attorney who helps advise on a lot of these things, he talks about when he first got trained nearly 30 years ago, it was $600,000 per taxpayer. I mean, it was right away you're immediately having to deal with. You start building a real estate portfolio or a profitable business, you got to address this right away. And so now we have a much higher threshold. But we have clients that are having successful business endeavors or real estate holdings and doing 1031 exchanges, and they're approaching that. And now we have to start talking seriously. Hey, how do we start, tackling these issues? Because there are some advanced estate planning strategies that your typical estate planning attorney, it's not their wheelhouse. Yeah. They need to be involved in writing the proper estate plan. But there's different types of structures that we can introduce and bring to the table that can help proactively mitigate that. Then also you got, we're sitting here in Oregon right now. Oregon has a $1 million estate tax exemption. Anything above $1 million, it starts at a 10% tax. It goes up to 16%. So that becomes real very quickly here in Oregon. The state of Washington, it's just under 3 million. Those are meaningful issues that we're looking at. Hey, how do we plan for that? What's the best strategies for wealth transfer? Those are really important conversations. And so we have specialists that can advise on those things to help people consider what's the best strategy for them and their goals and what they want to leave for their heirs and all of that.
Yeah, because I imagine people are probably coming to you. I mean, obviously, real estate investments is one vehicle that they're using. But, let's say that I'm going to sell my business and, we're going to net a considerable amount of money and I'm living in Oregon. Do you guys have conversations with people about, timing, maybe some, recommendations on how to manage that type of situation?
A very frequent conversation we're having with our business owner clients. Because while they're running a profitable business, there's always money being left on the table. There's ways they're not tax efficient. So we're helping them keep more money in their business and in their pockets while they're running the business. But then eventually they want to exit, whether it be passing it to the next generation, whether it be selling it to a buyer, whether it be converting to an ESOP and selling to an employee-owned cooperative kind of a thing. There's all sorts of different ways they go about this, but there's going to be some kind of process of liquidating that investment of their business, and that's going to have a tax impact. And so how do we address that in the most tax-advantaged ways? We find that is an area that is grossly being overlooked from a strategic planning standpoint. We partner with a lot of business brokers and M&A advisors who are working with these sellers, and they're not getting much support from their tax professionals on what to do about it. If they have a good tax professional, maybe they're getting a good analysis of like, hey, you're selling your business as an asset sale. It's allocated this much goodwill, this much equipment, this much inventory, and understanding those allocations and how it's all taxed differently. Maybe they're getting good analysis of understanding what they're about to face. But often they're being brought very little to no proactive opportunity about what to do about it. But I did just this morning have coffee with a phenomenal wealth manager who is leaning into those conversations with his clients. He's got clients looking to exit and looking at things like opportunity zones, investment, things like charitable remainder trust. So there's a number of different things you can do, and they all have limitations and they all have benefits. So that's a big part of what we look at of like, okay, here's the different options. Our role is not to tell you what to do. And say, hey, we want you to be educated on the types of strategies you can leverage and then figure out what meets your goals. Sometimes this is what it does. Sometimes I'm selling a business for $10 million and I'd like half of it to be in this deferral structure that gives me a lot of flexibility. That's the one I mentioned earlier that you can do for selling real estate or for selling your business. A lot of flexibility. I can work with my financial advisor to reinvest this in virtually anything. Tons of room there. It's phenomenal. People love it, and others are more illiquid, like an opportunity zone. To get the full tax advantage of that, you need to hold that for 10 years. And
Can you just unpack opportunity zones? We can get into it more later, but just for people who maybe aren't as familiar with that.
Oh, sure. Yeah. So, federal opportunity zone, these qualified opportunity zones are basically geographic regions that have been determined as, disadvantaged in whatever way or another. They have their criteria.
Yeah, blighted in some fashion.
Yeah. So if you invest in those, there's tax advantages. So because they're incentivizing kind of reinvesting in those areas to give them a lift, an economic lift. And that makes absolute sense why the government does that. The way the legislational opportunity zones have been historically is they kind of come in these phases and they eventually expire out, and then Congress re-ups them. And so this new tax bill just re-upped them. Now, I'm going to admit right now, this new tax bill is hundreds and hundreds of pages. It's been passed for, nearly 60 days ago as it got passed.
Yeah, in July, right?
Yeah, it was July 4th that he signed it into law. There's aspects of this that we're still unpacking. And so the very first things we dove into is understanding how it affected the R&D tax credit, bonus depreciation, the employee retention credit, a number of things like that. The estate tax exemption that it increased to $15 million per taxpayer. The qualified opportunity zone, I'm still getting my head around the details of it, but one is it extended it where you can keep doing it versus expiring.
Yeah.
They created kind of a staggered holding period where you can get a partial benefit after less years, like 5 and 7 and 10, I believe it, but don't hold me to it because there's so much to know and all these different things. But also before that tax bill passed, if you were to sell, let's say your business and you have a capital gains event and immediately invested in a qualified opportunity zone. So this is maybe a real estate development. Maybe you bought a property. It could be a fund that you invest in that's investing in opportunity zones. So there's different ways to do it, but you invest in an opportunity zone. One is you get a tax deferral. You don't have to pay that capital gain tax right away, but that tax deferral only went till the end of 2026. And so you still owe that tax before the investment even got liquidated. But then two, if you hold it for 10 years and then that gets sold, it's going to, real estate over a 10-year period.
Generally speaking.
I can't guarantee it, but historically it's going to grow in value. And all its appreciation, all the growth of value from your original purchase is exempt from capital gains, exempt from tax, which is phenomenal.
I mean, it's massive.
But the downside is you have to hold it for 10 years. And sometimes, depending on how well you vet the investment, and even if you thoroughly vet it, not all investments go the way you plan.
No, they do not. No,
and
especially in the last few
years.
Yeah,
it may not cash flow well. It might be losing. You never know.
Yeah.
And so there's risk, but there's advantages. But I've worked with business owners that are selling their business or people selling their properties and don't want to do 1031 that think that opportunity zone is the only way to address capital gains. We help them say, hey, that's one way that's viable with any of the cash that you can put aside for 10 years.
Yeah. It depends where you are in your life cycle, right?
And everyone's going to be different,
Yeah.
And there's other strategies that you take advantage of. There's things like charitable remainder trusts, which is carving out some portion of your ownership in the business before you sell it and pledging it to a charity. What that means is, you go to sell, the money goes in there, no capital gains due. You get a charitable contribution for that, which is awesome. You can actually have this money invested. You can take income off of it and pay tax as you get income. The downside is in your passing, any money left in the portfolio has to go to the charity that you named that it's pledged to. Nothing wrong with that. I love people that are charitable, that want to give to causes that they're passionate about. I'm all for that. The downside is that amount of funds can't be given to your heirs.
Yeah.
And so in that kind of situation, I have other business owners that they hear that from their financial advisor and think that's the only way that I can avoid paying capital gains. But then that cuts my kids out, and my grandchildren and all that kind of stuff. And so I either pay the tax and have it for my children, or I don't pay the tax and it all goes to a charity. And we show, hey, there's other options. There's ways that you could defer the tax and still have it as legacy money. But also if you want to carve out some portion to be in a CRT, as they call it, that's another great strategy to be able to not pay tax, but also have funds that can be given to something you're passionate about.
Yeah, and I think that's an awesome option because, what happens when you pay taxes is the government then spends the money how they see fit, right? And so, in that case, it creates an opportunity cost for, essentially where that money may have gone, right? And so, there's a lot of discussion around charitable contributions and how and civic engagement and how some of this stuff has kind of started to, show a pattern of decreasing over the last 70 years. And a lot of that is because you also see tax rates going up. And so people no longer have the ability to elect where they want to maybe make those contributions. And this is kind of restoring that in some fashion, it sounds like. Yeah.
No, absolutely. On one hand, I always clarify when I talk to my clients, look, I'm not anti-paying taxes. If you file a tax return, you're required to pay your taxes. That's important. Look, my kids go to public school. I have a son with a disability who gets disability benefits through the county, which is funded through the state and the federal Medicaid program. I'm grateful for that. what we've had to navigate with one of our kids and getting the care he needs, we would not have been able to do without taxpayer money. That's like very grateful. There's a lot of wonderful things. I love driving on roads, don't you?
Yeah,
I love
exactly,
traffic lights at work.
Yeah.
Like
Sewers and-
is it being done the most efficiently? Are there ways it could be improved? Of course, and we of course all can argue with how it could be more efficient and all that. But I think what everybody agrees, no matter what side of the aisle you're on, is there's improvements that could be made in how the government runs and how it spends its money. Absolutely. Paying what you're legally required to pay. Absolutely. There's important things that we get out of that, and I'm not against it. But there's nothing in the tax code, or I think even both legally and also morally, that says you're required to pay more than you legally
Well, yeah, I mean, they wrote the rules, right? So it's not like you're trying to do something. People use that term loophole, and it's like...
No, loophole gives the idea of some kind of, sketchy little error that they made in the tax code, and you're exploiting it. And then as soon as they catch it, they're going to close that hole, and now you're going to be out, and then they're going to come after you. No, that's not what we're talking about. We're talking about taking advantage of the tax code as it was written to be taken advantage of in a strategic manner that supports what your endeavors. That's what we're talking about.
One of the things that we've been kind of talking about loosely is this big, beautiful bill that was passed. It's not, I didn't name it, but you don't forget the name. But there's some exciting stuff that's coming down through that legislation for businesses, for all kinds of people. From what you've read so far, what are the things that you're just most excited about, either that is new or things that they've kept? Like, what do you think people should be paying attention to, or what are you guys thinking about right now with this new legislation?
That's great. First of all, I would mention, even though it is the one big, beautiful bill, I'll be the first to admit there's things in it I don't like at all. There's things that I think aren't good for our country, good for certain disadvantaged people groups, things like that. But like everything in life, you take the best of something and take advantage of it. And so there's opportunities it creates as well. And I'm grateful that they've been able to create those opportunities that serve business owners and real estate investors all over the country. So the key things that we've seen that are extremely beneficial, we mentioned the R&D tax credit, research and development, earlier. 3 years ago, some rules kicked in that were extremely unfavorable that made taking advantage of the R&D tax credit often actually have a worse impact on your taxes, which is funny, a tax incentive that actually hurts you to take advantage of. It was awful. People in lobbying Congress for the last several years to fix it. This tax bill included that. And for small businesses under 31 million revenue, they can retroactively go back the last 3 years and claim tax refunds.
So what's an example of like R&D for real estate? It's like, hey, we're going to do a new mechanical system for energy efficiency or like that kind of stuff?
Yeah. So in the real estate world, it usually gets into architectural or design and engineering. For a real estate investor, it's usually not viable for them personally, but a real estate developer. I've worked with a lot of general contractors that do design build work. And so they have in-house designers. They're doing some of that architectural work.
Yeah, material testing and research and stuff like
so
that.
sometimes, I've seen some that, they're like, I've dumbed it down to say, hey, do you ever have the opportunities you're trying to figure out how to do something?
Yeah.
And they're like, oh, yeah, like that's technical in nature. Yeah, we had a client that wanted us to build this particular structure, and we had to do some research. We had to test different materials to figure out what's going to hold up, what's going to bear the weight, whatever that is. I'm like, hey, that's generally speaking, that's R&D activities. And then we work at, identifying them and then figuring out what expenses did you incur in doing those things, which is mostly payroll dollars. You're paying people to do it.
Could you test paint or flooring? Like, because like when we think about tenant turnover and impact on just durability of products, or is that maybe
I see where you're going with it. And usually when I start talking, you're like, oh, tax incentives.
Yeah, so let's throw that out there.
You start thinking all sorts of different ways to go about it. Now, while something like that could be viable, it often comes down to a matter of scale as well. We find that for it to be worthwhile to claim the R&D tax credit, usually there needs to be, I've seen around $150,000 to $200,000 a year in R&D expenditures. And so that usually means payroll dollars. While it's certainly viable to, test different flooring materials to see how they hold up in different environments, conceivably there could be ways to do that in a manner that qualifies for the R&D tax credit.
Somebody who manufactures flooring could do that.
Exactly. So usually that comes down to flooring manufacturers, not the person buying the flooring to put into their rental. Do you know what I mean? But we have clients that are the flooring manufacturers. They're the fabricators, or they're, like I said, they're design build firms where they're doing the plans and they're doing the engineering of different structures and things like that. not aware that there's a tax credit that incentivizes the very work they're already doing. Yeah. And so anyway, back to the big, beautiful bill. That's a big one that has helped a ton of our clients put just literally money right back in their pocket to help grow their business. Another is the bonus depreciation, renewing at 100%. For anybody listening that's completely unfamiliar with it, when you buy a property, that by default, your investment minus the land value, because the land value, the dirt you bought doesn't depreciate. So the building and improvements, everything built on the land or modified with the land, you depreciate. Real estate depreciates over 27 and a half years. Residential real estate, 27.5, commercial, 39 years. And so you can restructure the depreciation through a cost segregation study, which basically itemizes, if you bought a property for $1 million, let's break it down to what did you buy? Cabinets and flooring and the driveway and the pool in the backyard and all the different components, the appliances, the water heater. Let's put values out of the million. This much was this much was that, and we're going to break it all down. A lot of those components, depending on the property, sometimes 25, 30% of it can go into these shorter lifespans between 5 and 15 years. Well, bonus depreciation applies to anything that's in those shorter spans.
Yeah, makes sense.
Yeah, and so when it got renewed to 100% with this tax bill and made permanent, which means it will stay there unless Congress writes a new bill that changes it, which is going to be complex and less likely to happen, which means you can buy a property and, it could be 20 to 30% of it. You can immediately deduct on your taxes this year rather than spread out over, 30, 40 years roughly.
Yeah, which can offset other taxable income.
Exactly. So it's hugely beneficial. So that was a big one I have a lot of investors taking advantage of, and we're literally waiting for this to get passed because it was at 40% this year and going to expire at the end of this year, down to 0. So there was no bonus depreciation if they didn't pass this bill. So that was a big one. We already mentioned the estate tax exemption getting bumped up to $15 million per taxpayer.
Yeah, huge.
And indexed for inflation. So it'll just keep going up with inflation. That's a really big one. There's another thing called qualified small business stock. So when you talk about people selling businesses, this is a unique thing most business owners never heard of before. Part of what's unique about it is if your business is a C Corp, and there's parameters around it on the size of business and all this kind of stuff, you issue, sometimes they call it founder stock, which are stock certificates claiming qualified small business stock, and then you hold that stock for 5 years before you sell. Old rules, the first 10 million of capital gains, and I'm simplifying it. There's nuances just to simplify.
Sure, yeah.
So that's my disclaimer. The first 10 million is exempt from tax.
Wow.
Well, this new tax bill bumped it to 15 million. So if I'm running a profitable business and I'm looking to sell and I'm running as a C Corp, which is generally not the most tax efficient place to be for a profitable business ongoing, sure. But I've seen founders or tech startups that get venture capitalist money. They're a C Corp because a lot of VCs want C Corps and how they're structured. Yeah. It's a whole other conversation. And they're taking advantage of qualified small business stock. And so this thing changed the rules to where if they hold that for at least 5 years and then they sell, the first 15 million is tax free.
That's wild.
It's phenomenal. It's wild. Most don't even know it exists. There's also ways that if you end up selling in 3 years, you can do a QSB as a rollover and roll those funds into another startup and still have the capital gains exemption. So there's a lot of nuances of those things. Well, this tax bill made that even more beneficial. So that was a really big advantage that to a lot of our people running startups. They're looking to get investment, grow, scale, and sell. Mm-hmm. It's a huge tax benefit to incentivize that.
No, that's awesome. You mentioned, is there anything in the bill that came out that you feel like maybe isn't good for business owners or the real estate field, or did you think most of it was all just positive?
I think most of it's very positive. Grateful to see they didn't make any changes to 1031 exchanges or anything like that.
We were worried about that, and interest deductions.
Yeah, and all that kind of stuff. A lot of my business owners are grateful that they increased, but only to a limit of what they call SALT, local tax deductions. Because in the previous bill, it dropped only $10,000, which means you can only deduct state and local taxes, which include property taxes on your residence, to $10,000 on your federal tax return. You used to be able to deduct all of it. And so they increased it to $40,000, which is nice. A benefit from the previous rules, but still historically not where we should be. We should be able to deduct any state and local taxes you pay, you should be able to deduct off your federal tax return. So that was a bummer that we didn't see that get, increased all the way. I'm trying to think, there was something else that we were bummed didn't get made permanent. Oh, qualified business income deduction. Oh, that was a good one. I overlooked that one. If you own if you're running a business as an LLC or an S corp, back in the Tax Cut and Jobs Act in 2017, they created this thing called the qualified business income deduction, or QBI.
Mm-hmm.
So if you're listening and you're a business owner, you may have heard of this. It is effectively a 20% deduction on your personal tax return of your business profits. So if your business was $500,000 in profit, that passed through to your personal tax return, 20% was deducted immediately on your tax return, which is $100,000. Again, there's parameters to it. There's situations that can minimize how much of the QBI you get, and there's certain industries that are totally excluded, which is silly, but they did that. But that was also going to expire at the end of this year. So this new tax bill renewed it at 20%, which is phenomenal. So a lot of our business owners are thrilled about that. They can keep getting that deduction on their personal tax return. So a lot of the disadvantages I see is more things like cuts to Medicaid programs and some of that kind of stuff. Naturally, as Congress is figuring out how to get a tax bill passed, they got to deal with budget issues. If we're reducing taxes here, we got to offset that with reducing costs somewhere else.
Spending and whatever
other
else.
spendings.
And
so, they've cut things. Some need to be cut. Some I think are going to hurt the country in the long run. But we all can have different opinions about that.
Sure. Yeah. Well, I mean, it's a moving target always.
Yes, absolutely.
Well, no, it's been great speaking with you, Justin. I want to pivot a little bit as we kind of wrap up here to give the audience a chance to get to know you a little bit more. So one of the questions I have, I'm kind of putting you on the spot, so it doesn't have to be anything super profound, but what's one of your favorite quotes and why?
Oh man. You didn't prepare me for that. You know when sometimes you get asked on the spot, your mind goes completely blank. And I'm like, I think of quotes all the time, and at this moment, I'm like totally drawing a blank.
Or like a phrase, their idiom that you live by.
Yeah. Let's see here.
I have two more questions I could circle back. If
Yeah,
you want,
do that. Because
Right, yeah.
give me a second. Go for it.
Yeah. Another question, which is, some people have thought about this heavily, some people have not. But what is your why? Like, you're out there, you're a founder, right? You started a business. That's not an easy way to go. Yeah. What is your why? Do you have kind of a handle on what that is? What drives you?
Yeah, I think all of us, if we kind of look back over our lives, even our childhood sometimes, we'll find ways that we've operated that just come naturally, things that excite us, and maybe they looked totally different in the way it played out or the circumstances, but it has to do with just kind of the unique way we're wired, whether we believe, we were created a certain way or whatever it is, there's just a unique bent we all have. So I was one that I would go to the grocery store with my mom as a kid. And that was back when you would cut coupons and all that kind of stuff.
Yeah, I remember that.
They had double coupon days and all this kind of stuff. And, I would be looking through them all and I'd look into the sales and I'd do all the math in my head. And, part of it is my way to get what I wanted. I wanted all the sugary cereals that my mom didn't want to buy, but I would convince her because, look, we got this coupon and this sale. If we double the coupon, it's almost free. Let's buy all the Captain Crunch, all that kind of stuff. And it's that idea of connecting dots, seeing how we could take advantage of these are opportunities to strategically be able to accomplish something we want. I get excited about that. And so I regularly tell people with what I do is I enjoy what I do. And most people can tell, I have fun. And people are taxes feel just god awful, and I'm like, oh, for me, it's opportunity. Yeah. It's exciting because when someone just sees something that seems like work, it seems obnoxious, and I see opportunity. And so that's something I just I enjoy. It brings me to life. And so as I uniquely kind of found my way into this as an insurance advisor who kind of saw these opportunities and kind of made it the pivot of I want to be the expert at helping people take advantage of opportunities that accelerate what they're passionate about. Sure. And what they're trying to do. That's fun for me. It's fulfilling. I personally enjoy it because I'm coming alongside other entrepreneurs, other business owners, other real estate investors, and helping them see the opportunities I see. Yeah. And helping them take advantage of it in the way that benefits them. That for me it's just very fulfilling. It's fun. It's how I'm wired. It's how my brain works.
Okay. That makes perfect sense. So the next question, and it could be neither, but I always like to ask people if they had to choose between whiskey or wine, what they would pick.
If you had caught me a few years ago, I would have gone wine all day long. But over the last few years, I've been developing a taste for whiskey and bourbon, and I've shifted. And locally, I love going to the Multnomah Whiskey Library. If you've ever been in Portland, really I love that place. Yeah, we have some friends coming in town actually next week, and we're nice. We know where we're taking them. Been developed a taste for it where now it's I love a good bourbon.
Cool. Very good.
Absolutely.
All
So
right.
you mentioned the quote, it's still partially drawn a blank, but I was raised in religion. And while there's ways that my life has shifted and my beliefs have shifted over the years, there's some key principles it's brought to me, and what sometimes this might sound really cheesy. People talk about the golden rule, that whole do to others as you do yourself. It still holds true. It's like there's some of those things that even figures like Jesus spoke to 2,000 years ago it's really about just being a good human.
Yeah.
It's about, hey, if I treat people with the kind of respect and kindness and thoughtfulness and honesty that I would want to be treated myself, I can trust that whether you believe in God or the universe, like this is going to come back and serve me. It creates the world I'd rather live in. And so even what I'm doing, we try to approach it not as a transactional, like we're just trying to get deals and make money. If I approach you from an educational standpoint, hey, we're not going to do anything secretive. We're not going to try to sell you anything.
Yeah.
We want you to understand the pros and cons of any strategy, of any incentive, so that you could make the best decision for you with your advisor supporting you. While that sometimes might mean an opportunity doesn't materialize because it actually isn't in your best interest. Well, if it was me on the other side of the table, I would want someone to take that approach to me, to really fully disclose the pros and the cons, the short-term and long-term benefits and costs and risks, so that I can make the right decision for me. I would appreciate that. And so we try to take that approach.
Yeah, I don't think you can ever go wrong with that approach. I think it's
absolutely
always going to work out in the long run.
And short-term, it could mean opportunities don't end up panning out,
Yeah.
And that's okay. But I think if you build a business that way, then you build trust and you build long-term relationships that we can collaborate and work together. There is enough opportunity everywhere for all of us, whether it be in real estate and tax strategy or whatever it is. Opportunities are there. And so if we support each other, if we're kind to each other, if we're collaborative, opportunities are going to find us.
Perfect. Well, Justin, really appreciate having you on. I guess the final question I have is, how can people reach you? Do they go to your website? Is there an email, a phone number?
Yeah, absolutely.
We'll have stuff in the show notes too, but...
Yeah, I know it'll all be there, but it's real easy. Or Elevated Tax Strategies. Our website is just elevated.tax. So that's not hard to remember.
Very easy.
We're here to elevate your tax strategy. And a key thing to mention is we start with complimentary tax strategy consulting. So there's no cost, because we want to find the opportunity. If there's no opportunities that are meaningful and viable that have value for you, then there's also no charge. And so there's really no risk to have a conversation around, what's here, what moves can be made, all that. So elevated.tax, my personal email is justin@elevated.tax, so that's not hard either. Feel free to go to the website. You can schedule a meeting with us. You can shoot me an email. Would love to have a conversation about anyone's specific situation and see if there are any opportunities that can support what they're doing.
Cool. Well, I love what you're doing.
Thank
Thanks
you
for coming on, and we're signing off here.
All right. Thanks for
Justin.
having me.
All
Good to be here.
Bye.